it's kind of a frozen market right now for that reason, because there is just a reluctance for people to give up these low cost mortgages. And I can certainly relate. I look at some of the properties we have and the mortgages we have on, there's no way it could possibly.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have David Hay. David Hay is the Co-Chief Investment Officer and Partner at Evergreen Gavical and the host and author of the Haymaker newsletter. He's been helping clients build their financial legacies for more than 40 years and has also built Evergreen Gavical, a business that manages $4 billion. He's an expert on the financial markets and can often shed light on overlooked segments of the economy, some of which we're going to talk about today. David, welcome to the show.
Thank you, Chris. Pleasure to be here. An honor. Thank you very much.
Yeah, no, I'm excited. We're going to talk about several different topics here today. It's between the debt ceiling and interest rates, CPI, home prices. There's so many things that we could talk about today. Before we do, I'd love for you to share a little bit about your background with the audience.
Well, I'll just say that I started in the financial industry many presidents ago, back when Jimmy Carter was in the Oval Office, and he's still with us, amazingly. But so 1979, and it was a good time to start in the business, because there was something that happened that was a little bit more influential or impactful than me joining the securities industry that year, which was Paul Volcker becoming head of the Fed.
Yeah,
and Volcker, of course, was able to destroy inflation or bring it under control, but he did destroy a lot of businesses in the process. Very painful time, and maybe that's relevant to what we're going through right now. But anyway, that event did kind of shape my career, because for about 40 years I was much a continual bond market bull and a believer in disinflation, and that really drove a lot of my positioning client portfolios, with a few times where we would be late in an economic cycle, and I thought it made sense to shorten maturities. But whenever you get inverted yield curve like we have now, I would extend, which, early on it was tough to get people to do because I was young and they thought I didn't know anything, and they were right. But the idea that, it's just contrary to human nature, right? To when short rates, it's like right now, well, if I can get 5% on a T-bill due in 2 months, why do I want to go out 10 years and get a yield of only, 3.8, whatever, on the Treasury note? But of course, when you go into a recession, interest rates typically fall, and first of all, you've locked in your yield, and you're going to get price appreciation. So that was a game that I played for most of my career. But when we hit just so people realize that I started out as your dialing, smiling stockbroker at Dean Witter, which is now part of Morgan Stanley. Then went to Smith Barney in about 12 years later, because they gave me an opportunity to be a portfolio manager, kind of with training wheels. And that also is now part of Morgan Stanley, ironically. But I went on my own in 2002, so over 20 years ago. Evergreen, which is now Evergreen Gavical, affiliated with Gavical Research, which is one of the most prestigious macroeconomic research firms on the planet. They have most of the big money managers as their clients. It's global. They're headquartered in Hong Kong, but they have offices all over the world. We have offices kind of up and down the left coast, west coast. And anyway, so we do this for a living. In other words, we're not kind of, like macro tourists or whatever. We do not just the big picture stuff. We analyze companies, which is kind of a dying art. And we've got a large team, because it's an expensive process to, really drill down, and we're willing to go anywhere in the capital structure. And we do have a tendency to prefer high cash flow, whether it's paid out or not paid out. But a lot of our clients want the cash flow and need the cash flow. Their paycheck, they're often retired, they've sold their business, whatever. And so we need to provide a livable income to them, which fortunately, thanks to what it's been doing, is a lot easier than it was for many years when interest rates were eliminated. And, that's kind of the positive of this. Of course, last year, because of what the Fed did in terms of tightening at such a rapid clip, really the most rapid since Volcker was at the head of the Fed, is that it created the first year for balanced portfolios since 1871. That's kind of a long time. So the pain was experienced last year, and now, hopefully there'll be some gain. But anyway, that's a little bit of a lead in.
No, I think that's terrific. And yeah, it was, I don't know if a lot of people realized that last year, especially even investors realized that what the Fed did last year, it just broke the 60-40 model in a lot of ways. And yeah, the modern portfolio theory, balanced portfolio, however you look at it, it did not perform well. But that happens, right? We go through cycles and different things. And I'd like to start with that, David. You've seen a lot of cycles during your career. I look back and I see things through real estate cycles. You were there during Volcker, and you were there kind of during this prior generation of inflation. My view is that the baby boomers came in and really pushed, the cost of money, right? Like supply of money, because they wanted money, they wanted to buy things, they wanted to buy homes, they wanted to buy goods, and I see interest rates as the kind of the cost of money, right? Which is, or the demand side of that. And to me, it's not surprising that we're seeing inflation again. It is surprising to me how quickly it ticked up in some sense, but then I guess we can look at it through COVID. But to me, we have millennials coming in, which are actually a bigger generation, a little bit more spread out than the baby boomers. So it's not a shock to see that inflation is rising again. What's your take on this? And how do you feel that the Fed or the government is handling it today compared to how they handled it during the late 70s, 80s?
Well, I'd say it's very different than the late 70s in that Volcker really rates up way above inflation. Whereas today, as much as Powell has raised rates, depending on which inflation measure you use, he's either kind of around it, maybe a tad above it or below it. I mean, there's a lot of different inflation measures out there. Most people seem to believe inflation is being underestimated by the government right now.
I would concur. Yeah.
Certainly the methodology was much different back when Volcker was there. They didn't do all these hedonic adjustments and other things which tend to under inflation. But even ignoring that, I mean, this is not like 8% above inflation, which is what Volcker was able to achieve. And no wonder, despite what you're correctly saying, that at that time there was a tremendous amount of demand for everything from the boomers, which was kind of inherently inflationary. But lacking that today, you still have surprisingly non-transitory inflation, at least surprisingly to the Fed. So kind of linking back to what I was saying earlier, in the summer of 2020, when COVID was still raging and the global economy was largely locked down, the 10-year Treasury fell down to a 0.5% yield. You would have thought the government might want to term out its debt at that point, which it was producing in enormous quantities because of the fiscal deficits at that point. But you really had, to your point of where did the inflation come from? And this is what really turned me from being a bond bull and bond bear. Was we were effectively doing modern monetary theory at that time, MMT, which meant just, don't worry about any kind of budget restraints. Just, if you need to spend the money, spend the money. And if there's not enough demand from the bond market at interest rates the government can afford, then the Fed just steps up and buys the debt with their magical money machine, as I call it. So I think that's
David, and that's, if you don't mind, if you can go back and just, for the audience, do a quick primer on what modern monetary theory is. I know you just mentioned it, but if you could just expand upon that just for a moment.
Sure. Well, so in my newsletters, and I was writing a newsletter I have been writing a newsletter since 2005, really started writing about the housing at that point, which I thought was going to be a disaster. But in the spring of 2019, I really went on a bit of a tirade against monetary theory, because that's when it was first being really advocated by particularly Stephanie Kelton, but others, and eventually endorsed by Paul Krugman. And to me, it was, always the problem was going to be with inflation. So this idea that you don't need to have any kind of governor on the federal government is really kind of the essence of MMT. Just if the money needs to be spent, just spend it. And the trouble is that if you run these massive deficits and there's not the demand there, and there's not the demand that there used to be for U.S. government debt. For one thing, we have foreign central banks that are sellers, not buyers. So when you do an MMT type of thing, which is this just spending tsunami, so it's, that's a good point to contrast that versus QEs, because, QE1 was launched in 2009, and shortly thereafter QE2, 3, I call them the ocean liners. And then unofficially QE4 during the repo crisis in 2019. But it didn't really create much inflation. Over 10 years, all those trillions that were, again, produced by the Fed's magical money machine. But then those QEs went to kind of put into hyperdrive, because during the COVID period, you had these, the trillions of dollars that were sent out in stimulus and other, PPP, and some of these things still going on. This payroll protection plan, which is still happening now, and New York Times just wrote an expose on it that it's, like $100 billion over budget and rife with fraud. And anyway, so trillions of dollars were not only spent by the federal government, which was different than during the QEs, where, running deficits, but nothing like it. Was an absolute spending explosion during COVID, and it was financed by the Fed. So before it was mostly monetary stimulus, then it became fiscal and monetary. And then, of course, you had shortages. The supply chain, the global supply chain was, severely compromised. So, just a perfect recipe for inflation to go ballistic. And so in, the late 2020 period, in early 2021 in particular, I really jumped on have a lot of inflation bandwagon, and got into some opinion exchanges, later that year at the Malden Strategic Investment Conference. Malden's deal with
I like John a lot. Yeah.
And I was I was very much in the non-transitory camp, and I was kind of a lone ranger, but there were, Jeremy Siegel kind of on my side, and my partner Louis Gobb, and I wasn't the only one, but it was somewhat controversial to believe that, and very different than what I felt for the first 40 years of my career. So it was a tough transition, but modern monetary theory was always my belief that Achilles' heel was inflation, and this idea that, well, as soon as inflation shows up, the government can take care of it. They can raise taxes, the Fed can raise interest rates, and it's just proved to be a lot tougher to deal with than the optimist contended.
Yeah, and it doesn't seem like it's like, as you said, it's non-transitory. It doesn't seem like it's disappearing here. And I love to talk about how investors can take advantage of that. As we speak, we just the CPE, the latest Case-Shiller home price index came out, and you can look at it seasonally adjusted, non-seasonally adjusted. One says one thing, one says the other. But as we were talking before we started recording, David, the bottom line is prices of homes are the highest they've been. And without a doubt, prices of homes, if you take the cost of a mortgage with rates where they are the highest they've ever been in history. What's your take on that? And how do you feel like that kind of ripples through the market?
Well, I think it's just suppressing volumes, because people want to buy a house, and there's people that want to sell a house. But okay, let's think about the seller, which I don't think gets enough attention. If you want to move, let's say you were smart enough to refinance, or you bought when interest rates were very low. Do you really want to give up that mortgage and move someplace where your mortgage payment's going to be, or your interest rate could be double or triple initially? Right. That's a tough one. So that's limiting supply. And then builders are obviously reluctant to create a lot of inventory when they look at the affordability. They can see the numbers as anybody else, probably better. So you have this odd situation where prices really should be falling, given how high prices are and how high interest rates are, but they're not. Or they're falling a little bit, kind of like we were saying with the Case-Shiller. And I just read with David Rosenberg, the famous Canadian economist. I know you've got a Canadian wife, so you probably like Rosenberg. But he's saying that, and he's citing, I forget what source it is. I don't think it was Case-Shiller, but it was an official source, that prices are down something like 7-8% from the peak. In some markets, I think you got down more like 20 or 30%.
So San Francisco, New York, some of these bigger markets where you've lost a lot of population. You're certainly seeing double-digit plus declines.
But it's compared to the office building market, the housing market is a port in the storm. I mean, it's relatively tranquil by comparison, but I'm sure you're seeing some of these just horror stories about trophy office buildings. 350 California Street in San Francisco is, was 350 million, or at least the last transaction, that's 60 million that they're talking about selling it for. And hearing about even in Texas, 25 cents on the dollar transactions happening with office buildings. And so that's the weakest point of the real estate food chain right now. But I know you guys have a lot of interest in apartments. Apartments are an interesting situation, that very different than housing, where you could argue that there has been overbuilding. I think in certain markets, unquestionably, there's been overbuilding. Yet I know there's a lot of demand because you get quite a few people that can't afford to buy a house, just like we talked about. You've got boomers that are supposedly, in some cases, selling their home and renting because they save money and lower upkeep and more mobility. But it's kind of a frozen market right now for that reason, because there is just a reluctance for people to give up these low cost mortgages. And I can certainly relate. I look at some of the properties we have and the mortgages we have on. There's no way you could possibly replicate that.
Yeah, it really is an interesting market. We have some residential stuff here locally in Asheville, and what we see is that buyers that are coming in, they're selling their house in, say, the Northeast, and they're just paying cash. So interest rate's not a concern for them. And on the apartment side of things, what we're seeing is that we have a tremendous demand. Our build to rent communities our vacancy rates are almost non-existent because people can't buy, because between the down payment and then the mortgage, that's typically, say, 30% higher, maybe even more than what they're paying for, a nice luxury build to rent community with amenities. They don't have the ability or it doesn't make a lot of financial sense to do that. So, we're seeing, and then we're seeing, those kids, those millennials moving out of their baby boomers' parents' basements and saying, hey, I want to go live on my own, or, I want to form a family. So it's a really interesting market. And it certainly is regional or local, I would say, where you have people that are moving to, like, the Southeast. They're moving away from certain areas. San Francisco is interesting. There's a lot of different things politically, as well as financially, with different things that are happening there. But the bottom line is, I think what you said is we have to underscore, which is we just have not seen the transaction volume this year. It's been the slowest we've ever seen. It's been pretty incredible from that perspective.
And that's amazing. And your market is hot as it is, as you just said. Yeah. But I think what you're touching on is that we are seeing in so many ways, but it certainly has big impacts in real estate, this north-south migration. And I think that trend has legs. I think that's going to continue to play out. So I think it's going to benefit you guys. And if you can find properties that have great fundamentals in those markets, you're going to do very well.
Yeah. David, you and I could talk about macroeconomics all day long. I love this stuff. Hopefully, I'll get to meet you at Malden's event here in the future. But I would like to talk about your book. I'd like to talk about how people can get it. We can share that at the end here. But Bubble 3.0, I remember reading about kind of the bubble here, in 20 years ago, and so with rates where they are, with inflation where it is, with the stock market and the housing market at all-time highs, where can investors go for income? Where can investors go for returns? And, if we're in a bubble, what do we do?
Well, first of all, I think we're in an echo bubble, to get right to the bottom line. I think Bubble 3.0 hit its crescendo in 2021 in what I would call the peak insanity period. So that's when the meme stocks went absolutely ballistic, and GameStop went from $5 to $485 a share. You had the SPACs and the NFTs and just on, and of course the cryptos. And it is amazing to me that Bitcoin continues to trade it is, and some of these other related entities, when you've had just one scandal after another and trillions of dollars of wealth wipeout. You would think people would be very, very leery. And I realize Bitcoin's got special attributes that a lot of the other ones don't have. But I mean, Dogecoin is once again going nuts. And that was the one that I focused in on the most in my, the biggest bubble ever chapter, was Dogecoin having an $88 billion market cap, when founder Billy Marcus said it's worthless. What are you thinking? That's like more market cap than certain blue chip companies. So, when in the world when NVIDIA is trading at $1 trillion market cap, 88 billion doesn't sound like that much, but for something that's got no intrinsic value and had a ton of imitators, it made absolutely zero sense. But it was just kind of the signature bubble within the biggest bubble ever. But I think it's important to understand the connection between Bubble 1.0 which you're touching on, which was the tech bubble of the late 90s,
yep.
which then, because it burst, and of course the NASDAQ went down almost 80%, a lot of wealth was lost, and that created actually a fairly mild recession even before 9/11.
Yeah.
And then the Fed kind of panicked, and they were under a lot of pressure, mentioning Paul Krugman again, Nobel Prize winning economist, amazingly. But he really pressured the Fed to, this is where I think people really were asked about his reputation. They would give him a lot more heat for this, but he really put a lot of pressure on the Fed back in the kind of the 2003 era to create a new bubble, and he specifically recommended housing. And guess what they did? They pushed interest rates down to Great Depression levels, left them there, even as the economy started to grow and housing was going nuts. And they finally started to tighten in 2004, but they did it very slowly, a quarter of a point over several years. They did get the rates up about where they are now, but of course inflation was a lot lower, so it was a more of a real interest rate. But again, just the predictability and the snail's pace of it didn't puncture the housing bubble early enough. So it got greatly inflated. And of course, all those mortgage products that were created, all those CDOs and transforming subprime mortgages into AAA rated securities. And the banks were loaded up with that stuff. And when those AAA securities went down to 40, 50 cents on the dollar, virtually every bank in the country was broke, which you could make the case today. And this time it's because government securities mostly, but even the mortgages, if you mark these 2.5% mortgages to market. I mean, Chris Whalen is a genius on the banking industry. He was early to say, hey, people are way too sanguine about higher rates in the banking system. He thinks that virtually every bank, if you truly mark their everything to market, has a negative net worth. And that's what we had, even worse back then. And we had a mark-to-market rule, so these guys had to actually take hits on it, and it was the perfect storm. But so that we know how that turned out. But that's what really caused the Fed to do all those QEs, and eventually to obviously COVID played a big role in why MMT was implemented. So these things are all linked: bubble 1.0 tech, bubble 2.0 housing, and then what I call the everything bubble, bubble 3.0. And the reason I think it was so huge is because interest rates went down to virtually zero. In fact, in most of the world, a lot of the world, they were negative. Certainly in Europe, you had $18 trillion of negative yielding bonds. There were homeowners in Denmark getting paid to take out a mortgage. So you created a massive real estate bubble globally again. And some of these markets are really having a tough time. Some of these markets, the prices are falling much more than in the United States, and they don't have the protections that we have. We have, in a lot of states, non-recourse mortgages. We also tend to have long-term fixed rate mortgages, as in a lot of these countries, like the Scandinavian countries, Canada, once again, Australia, New Zealand. The mortgages are shorter or they're variable. So the higher interest rates are having a very severe impact on people's cash flow, forgetting affordability. But I saw that in Canada, it's like 70% of the average disposable income is going to basically just the essentials of life, including mortgage payments. And anyway, so bubbles are dangerous, and they're especially dangerous when they involve the banking system, which actually I didn't think this one would, but it clearly has. And right now we feel like the banking crisis is over. I don't think so. I think there's more lurking out there, because we're still in this process of depositors realizing, why do I have my money in a bank account that's paying me nothing when I can get 5% on T-bills? So it should be happening faster than it is, but it is happening, where money is moving from bank accounts into T-bills or government guaranteed money funds. So what does it matter? Well, it matters because when the money's in the banking system and bank deposits, it's high octane money. As we know, it's a fractional reserve banking system, so money can be lent, exactly. The money multiplies by one. So when it goes from a bank account into a government debt security, it's basically going from high octane to low octane. We have the money supply falling for the first time in decades. And now you're going to have velocity falling, because the velocity of money is definitely impacted by that transition I just described from high octane to low octane. So falling money supply, falling velocity, I mean, that's a major issue, because if the old Fisherian equation of money supply times velocity equals basically nominal GDP, or total economic activity. So it's a big deal see what we're seeing, but I don't think people are really focused on that right now. I think they're focused on AI and NVIDIA, and they're kind of ignoring some of these more powerful trends.
Yeah, I think that's an excellent point. Last panel that I was sitting on, we talked about, is this debate, were we going into a crash this year? And this was early. I forget if it was late last year or early this year. But my point was, you have to look at credit creation. At the time, credit was still being created, so it's probably last year. But now, as money exits the system, credit is shrinking, and purchasing power is shrinking, whether that's for real estate or otherwise, and that's a real multiplier effect. So that's what I think kept inflation low for so long after the Great Recession, right? We had such a destruction of credit that came out of there. So David, I know that your firm has really focused on helping investors find income, and as you mentioned, it's really hard for a lot of years to do that. In the new world disorder, as you call it, in your book and in your Substack, where do you see opportunities for investors here in the future?
Well, I think they're going to be more attractive in a few months than they are right now. And so you were just saying credit, and so I wanted to take that and add another word to it: credit spread. So this is kind of a big caveat about why I don't think you should be fully invested right now in, say, corporate bonds, which superficially look good. And there certainly are some opportunities, but I do worry that credit spreads right now are way too tight relative to some of these trends that you were just talking about. Like, let's talk about,
explain what a credit spread is.
Absolutely. I'll do that. And then I want to explain why I think they're going to widen out. But so a credit spread is very simple. It's the difference between what a corporate bond pays and what a government bond pays. Even though it's simple, it's also extremely powerful. Because if you really look at the big bad bear markets that have happened, even last year, it's because credit spreads have widened out drastically. If you go back to the 08-09 market, which really was a bloodbath for stocks and particularly for corporate debt instruments, that's when junk bonds went to over a 20% yield. And you had a bear market in stocks, but you had a mega bear market in yield instruments like corporate bonds and pipelines and REITs and so forth. So credit spreads actually got as wide back then as they did in the early 1930s. So it was the buying opportunity of multiple generations. And I don't think we're going to see that. But right now, we've got credit spreads just kind of normal. And they weren't last year. Now, last year, they did widen out significantly. That's one reason why a balanced portfolio had such a tough time. So and then if you look at when credit spreads started to narrow, which was kind of last summer, they were still fairly wide in the fall, but then they've narrowed significantly then, which has created a very nice tailwind for the stock market, but also for these yield instruments. But you were talking earlier about the changing of the bank attitudes towards lending and the credit standards. So the senior lending officer lending standards have tightened drastically. I mean, they are really at fire levels. So these banks don't want to lend money. And if you look historically, the correlation between credit spreads and that is very tight. So what I'm saying is I think you're going to see another move out in credit spreads, which is likely to put downward pressure on the stock market, corporate bonds. But there are opportunities out there. I mean, the biggest copper producer in the United States has got bonds trading at about a 640 yield right now in 11 years. You've got a lot of the high quality energy E&P companies, including Warren Buffett's, one of his big energy plays. Their bonds are yielding about 6.5% with a kind of a similar maturity. So those things look attractive, but could they go to 7.5 or 8 during a major spread widening event? Yes, they could. And that's why I'd be careful. I think it makes sense right now to do a little nibbling on those kind of things, but I think it does make sense for an investor to have a lot in short-term treasuries and get that 5% yield. Now, that yield, once we go into recession, which I think is coming, the Fed is going to cut. My joke is they're going to cut like a chef at Benihana. They're just going to chop, 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 chop.
Yeah.
But we're not there yet. I mean, right now, there's enough inflation in the system. The Fed doesn't want to repeat the mistake of the 1970s where they eased too early and then they had to tighten again. And so I think we're a ways away from kind of this ideal moment to be an income investor. But I do think things like midstream energy, the pipelines are attractive. They yield 7 to 8%, sometimes even little digits. one of our favorite names, actually is up 40% today. It had been our dog, but it's it's part of this budget, this debt ceiling relief. Their pipeline is going to get approved, which is like 90% done. It's been one of the real travesties that this thing has not been allowed to be completed. So, there are opportunities out there. I think you just have to be specific. I think some of the energy producers themselves pay very good dividends, and, bonus dividends when times are good. They're not going to with oil at 70. I do believe oil is going to have a major up leg here over the second half of the year. I've been saying that, and it just keeps getting pounded. But I do think I think OPEC is very unhappy with oil prices where they are, and there's a massive short position on the futures oil market right now. So in some kind of additional supply squeeze, those guys can get squeezed hard, given how many have negative bets on. And inventories, as you know, if you adjust for all these SPR releases, petroleum releases that have been going on, oil inventories are not just low, they're just alarmingly low, multi-decade low, especially relative to demand. So it's talking about an odd situation. I mean, the fact that you would think that with inventories as low as they are now, oil would be $40 a barrel higher than it is. And I think it will be before too long. So I definitely think there's opportunities in energy, and you can get paid in many cases very well to be in that sector.
Yeah, it's always interesting to me if you look at Democratic regimes have served the oil markets very well historically in this country. It seems that that's going to continue here. Another interesting topic you mentioned during one of our conversations was uranium. Would you mind touching on that for a couple of minutes, David?
Sure, absolutely. Because one of the
it interests me a lot. I think a lot of people don't really think about that.
No, they don't. I would suspect that the average investor has either zero or a very, very small allocation to anything uranium related. And there is an ETF from Canada, but it trades in the U.S. as well, that provides very easy access to direct uranium ownership. But I think, there's a lot of negative stuff out there. I mean, it's probably the scariest time I've ever seen in my life. I mean, I think we are facing I call it the 4Fs scenario, a federal fiscal funding fiasco in the second half of this year, which this debt ceiling is only making worse. So the government's going to be just selling a slew, a couple $1 trillion of debt over the next half of this year. And especially with the Feds, they're doing the opposite of QE, they're doing quantitative tightening. So you've got shrinking buyers, and when we're talking to foreign central banks, they've gone MIA. So you've got this explosion of supply with shrinking demand. It's a recipe for, you could actually have a failed treasury auction. I think that's a greatly underappreciated risk right now. And if you listen to Stan Druckenmiller, who's a brilliant guy, he's saying, our present value of our entitlements are about $200 trillion. That's relative to an already horrifying $31 trillion of on-budget debt. There's no way we can pay that, much less all these entitlements. So the math just doesn't work. And it's just a question of when do we really hit this, Wile E. Coyote off cliff moment. And I think there's a very good chance it could be the second half of this year. So that's a, big negative that scares me a lot. But there's an emerging positive out there, and it's gaining more and more focus. And that is small modular nuclear reactors. I think they are finally, there's been a lot of promise about them for many years, but they're really starting to get a lot of support from the federal government, which has been missing in the so-called Inflation Reduction Act. There's support for that. And molten salt nuclear technology, which was originally developed in the 1960s by molten salt. So it's another way it's a much safer way to cool a reactor core than using light water. Because we've seen three major disasters with these light water reactors. One was, that's Russia. They didn't have very good safeguards. And then 3 Mile Island, where the safeguards were much better. And then, of course, Fukushima, which, they had just an unbelievable sequence of things. But, you actually had hydrogen explosions there, that's terrifying. Yeah. Because it takes a tremendous amount. So, H2O is hydrogen and oxygen. And it's an unbelievably strong bond between those to keep them, imagine that's what you pour on a fire, right? Well, that doesn't just explode. It's because the oxygen and the hydrogen are so tightly bonded. But if you create enough energy, like in a nuclear meltdown, you can actually break that bond, which creates this enormous explosion. And yet with molten salt, you don't have that. It's a much, much safer approach. They're walking safe. And the technology has been around since the 1960s. It was developed by the Oak Ridge National Lab, and one of the fathers of nuclear energy, Weinberg, was a very strong proponent that we should go that route rather than these light water reactors because it's so much. The bottom line is the next generation of nuclear reactors is coming to market. Now, whether it's 5 years from now or a year from now, I don't know. I think it's going to be closer to a year. There's a company I'm very supportive of that I think could be at first fission next year, which would be shocking. But these things can be made in high quantities, assembly type of thing, instead of these customized, $20 billion plants. And so I think that's coming. And the demand for uranium is already soaring. And you've got 60 nuclear reactors under construction now. These are the old-fashioned ones, but they tend to be built mostly in other countries. It's so hard to get a reactor built in the United States. I don't have to go down that path. But of the 60 nuclear reactors globally that are in construction right now, under construction, about a third of them are in China. Hundreds more that are in the design stage, and reactors that were taken offline are being put back online. So the demand for uranium is surging already, and the supply is down. So this is like the oil industry. But you've got this great growth kicker of these small modular nuclear reactors. So it's a great setup. I mean, there's other ways to play it. That's not the only way to play it, but I think kind of the simple way is just say, I'm going to bet on the metal going a lot higher. It's traded much higher than where it is now. In fact, it's probably below the production cost for new uranium mines. Almost for sure it is. So I think it's a great setup.
A good time to take a look at it. Yeah, I thought it was interesting. The Finnish reactor that just came online, it had such an impact on energy prices that energy prices or electricity prices actually went negative after they brought that nuclear reactor online. So they had to pull back on production to get prices up. So people were incentivized, or producers were incentivized to continue to do it. It is interesting the way some of these. And look, I'm an environmentalist, so it's really interesting to see how some of these quote unquote green technologies have affected energy markets. And you look at Germany. So I think uranium and nuclear power is really interesting space to look at going forward. I would love to continue this discussion, David. Love to have you back on the show. But we have to wrap up for today. If listeners want to stay in touch with you, I know we can almost see your Substack page entirely here behind you.
I should do a little better job here. How about that?
There we go. Perfect. Yeah. And we'll put this in the show notes. It's haymaker.substack.com. If you don't mind sharing, how can people get a copy of your book? How can people stay in touch with you, get access to your newsletter as well?
Well, it's easier to get the newsletter because it's free, and all you have to do is just you do have to subscribe. So go to our Substack website, Haymaker, and subscribe. You just did it, so you found out it's pretty easy. Very easy. If somebody wants to get a copy of Bubble 3.0, we'll send it to them free of charge. You have to let us know. Just send us an email or we've got a Twitter account as well that we're fairly active with, so they can also contact us there. We're easy to reach, and I'd be glad to send anybody a free copy of the book.
Terrific. And we'll put all that in the show notes as well. David Hay, it's been a pleasure talking to you today. Hope you enjoy the rest of your summer here.
Thank you, Chris. Hope to meet you in person soon.
Yeah, look forward to it.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.